When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Fogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Fogan. And now here's Jeff Fogan and Jeff Shea.
Thank you so much. Welcome to Premier Retirement with Jeff Fogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about markets, politics, and retirement income, what really matters right now. Also, we're going to challenge the 4% withdrawal rate. We'll answer listener questions. And finally, rebalancing your investments as you near and enter retirement. My name is Jeff Shade. As always, I'm just here to ask the questions. But the words of wisdom and solid advice, they come from the other Jeff in this radio program. It's Jeff Fogan, founder and president of Premier Retirement Planning and Wealth Management. Jeff, how are you doing today?
I'm doing great. How are you doing?
I'm doing fantastic. Thank you. Hope everybody else is having a great weekend. We really appreciate you joining us every week here for Premier Retirement. Jeff, let's start off this week by talking about the CPI numbers. They came out this past week, the Consumer Price Index. What were those numbers, and were they what you expected?
Well, I think the Consumer Price Index was lower than expected, and so was the inflation numbers. The inflation numbers was really nice to be down at 0.2%, which is a annualized of about 2.4, which is lower than it was expected to be. It was supposed to be closer to 2.7 to 3. The actual CPI came in pretty close to expected, I think a little lower than they thought, and it was 0.3. So the Consumer Price Index did go up a little bit, mostly driven by, I think coffee prices were higher. Fruit prices are always higher in the winter because there's less of it and has to be imported. Some of that includes tariffs. So we're seeing a little bit of a price increase. Now, we know tariffs do have an inflationary push. In some cases, food being probably one of the biggest components to that CPI increase this time of year. Stands to reason if they quit selling farmland to China and taking the dirt and shipping it over there, like Bill Gates has supposedly been doing over the last few years, we'd have a little bit more farming and maybe some more competitive pressure on those prices, which is what manufacturing is trying to do by increasing the tariffs on foreign countries. Their imports are down. Now, other foreign countries, interestingly, even though their economies are slowing because they're not exporting as many goods to us as they used to, just basically because of tariffs. It's also increased many American-based businesses to where their sales are up. And interestingly, it's created some increases in economics, especially for the small cap companies. That sector of the market is actually showing up with earnings where it hasn't for some time, which has really been my biggest fear about this economic slowdown is the economic indicators have been getting worse and worse. A lot of that is because of pricing pressure, because the lack of tariffs has made anything that was manufactured to be manufactured cheaper overseas. Now with the tariffs, American-based companies are a little bit more cost-effective or have more cost-effective production costs. And even though the CPI is up, I think it bodes well for the economy overall. There were some decreases, especially in oil and gas, that kind of helped mute those consumer price indexes going up. And inflation was only 0.2. So that's actually looking good. I'm getting more encouraged after the first year of Trump than I was during the first year of Trump, even though I think he's a businessman that knows how to fix economic woes. I'm not really sure I agree with all the things that have been happening, but what he's done is not increased massive inflation that everybody was warning and screaming about. It hasn't increased the chances of our recession. It's actually decreased them because more production on the home side, American-made goods, and we can get farming to catch up. Although in the wintertime, there's probably less we can do with that anyway for a lot of the fruits and vegetables that we like to eat during the wintertime as well. Bottom line is it wasn't as bad as we thought. We've got the employment and jobs numbers are in line with about what they, maybe a little soft, but in line with kind of a recovering economy rather than a sliding into recession economy or a booming economy. Certainly we're not in a booming economy. And I'm a little bit more, just after these numbers today and just over the last couple of months, since the government shutdown, we kind of got back on to where we can provide these accurate numbers. I'm not unimpressed with how we're doing things. You know, food up 0.7, steak prices up 3%, coffee up 2%, eggs actually went down 8%. So that kind of muted those figures. Food at restaurants and other outlets a little bit higher. Energy prices decreasing, which again helps soften the blow a little bit. So I'm optimistic and very positive about the possibility that we don't have to go through a big market sell-off and a correction, even though I think the market is still completely overvalued, way overvalued compared to history. But, if we keep on this track where, especially the smaller companies, not the bigger companies, now we've seen some of those Mag 7 companies kind of stagnate. NVIDIA is not growing like it used to. Apple's actually one of those stocks that I would be shorting right now, meaning it's got downward pressure. We've got a lot of tech companies that have kind of run their gamut, but now we have the smaller mid-cap and small-cap companies starting to catch up a little bit. So that actually is a good thing for the economy because there are a lot more small companies than the big ones. If that can continue, then I think earnings can maybe catch up eventually to this overvaluation of the stock market. Now, does that mean it can at least kind of stay stagnant or bounce around until that catches up, or is it going to continue to be way overvalued? If the market continues to be screaming ahead of those growth numbers and those earnings numbers, I think we're still in scary times for whipsaw action and even a market correction that might sting a little bit. But then again, if you made 20 or 30% in those risk assets over the last few years, I mean, if the market did go down, you're not giving back everything. Were you in a position to take those risks? Maybe, maybe not. If you weren't, maybe you don't want to continue to add too much risk at this point in your life. But I feel a little bit more optimistic myself with my own portfolio and the portfolios of my clients to be willing to take a little bit more risk, given the fact that the underpinnings of the economy are supportive to maybe an overvalued market. I shouldn't say that, but fundamentally speaking, we're actually seeing some fundamentals that are starting to make sense rather than make zero sense. So CPI numbers look good. Jobs numbers maybe not so good. Inflation really good overall, but those things that everybody needs like food went up a little bit more than we'd hoped.
Talking with Jeff Ogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. If you're within 5 to 10 years of retirement, you don't have a written plan, it's time for you to get your retirement roadmap, and you can get yours today by calling 520-780-9059. Schedule your complimentary review today with Jeff. And again, you can make that call, 520-780-9059. Leave your name, telephone number, and Shelley will call you back and set up that appointment. Once again, there is no cost and there is no obligation for this whatsoever. Jeff, our recent survey found that 73% of investors over the age of 50 are anxious about how market swings could affect their retirement income. Are you seeing those concerns in real life with the clients that you meet with every day?
Absolutely. I think if a client's so ready to meet with a financial advisor, they're probably even higher than that 73% concerned rate. I don't think people are just looking to get a new advisor because they think he can make an extra 1 or 2% on his portfolio. Maybe that's the case, and we do get those, but a lot less frequently than those people that say, okay, I'm getting ready to retire. Am I going to have enough? And a lot of them come in a little bit oblivious to the fact that the market could correct 50%, and that would be devastating to their retirement plan. And we explain that to them, and then they do get very concerned if they're really looking in a serious way to make sure the retirement funds last a lifetime. And that is a big concern. So yes, I see that on a day-to-day basis. And if it's not in your mind, it should be, because the old 4% rule has been proven not to work, even though the stock market averages 10% over history and the bond market averages 5-ish. It's weird that combining those two, even if the 50-50 split, you should be averaging 7.5%, yet you can't take more than 4% out without being statistically probable that you won't run out of money. In other words, inside the probability of statistics, the bell curve, if you've done a stats class, you know what that is. The probability that it's almost impossible that you won't run out of money as long as you take less than 4%. Well, that's actually been debunked based on the two market crashes we had in less than 10 years apart in 2000 and 2008. And Wade Pfau, who's a PhD in retirement income, and actually there's some schools are offering a degree in retirement income, and there's even a designation out there like CFP, Certified Financial Professional, that mimics it. It's called Retirement Income Specialist Professional, RISP. This is getting to be a bigger and bigger part of the financial planning industry, is making sure income doesn't run out. Now, interestingly, that happens mostly on the independent space. It very rarely happens in the stock market because their whole model is built on you risking your money, them making the difference between bid and ask prices on trades in the stock market and all the volume that they move money and fees that they charge on mutual funds, ETFs, and managed accounts. So because it's fee-based and they're all securities-oriented, they love to talk you into believing that the stock market averages X, it always comes back. Just take as little of it as you can and live a meager lifestyle and keep growing your assets so you'll have enough when you're in your 90s in case you need it for nursing home or you want to leave an inheritance. Well, you can do things with a lot more peace of mind and guarantees and confidence if you take maybe a half or even 2/3 of that money, put it in a strategy that guarantees enough income to live on, pay all your bills, and then you don't have to worry about what happens in the stock market. In that case, you can ride the roller coaster. I heard Dave Ramsey say, and I'm not necessarily on board with all of what Dave Ramsey says, but this one I am. If you're investing for the long term and you have stock market money that you want to hold for a while, if you're not using it for income, It's like you're on the roller coaster ride. You don't want to get off in the middle of the ride. That's when people die, right? If you're using income from that roller coaster ride, you are getting off the ride with a little bit of your money at a time. So it only works with those funds that you do have a long-term horizon on, don't need for cash. And that can't be all your money. It doesn't work that way. It won't work that way, even though a lot of people in the industry think that Wall Street has the highest average return, so you might as well keep it there. Well, it also has the most volatile returns, so you shouldn't necessarily keep it there. Income is a big deal. And if you don't really look at what volatility will do, you're probably going to get caught by surprise, especially when you enter retirement. If you're looking at entering retirement within the next few years, or if you just entered it, you're getting out when the market's near a historical high level, meaning based on the price of the stock market, based on the earnings and the gains and the fundamentals that typically dictate how that pricing should work. Now, could it be different this time? Well, I don't know. That's the most dangerous words in the stock market and investing, according to John Templeton, who's now deceased, but a very wise man who built a fortune in the stock market. Always said, buy when everybody's selling and sell when everybody's buying. Warren Buffett says the same thing. John Templeton always said, the worst thing you could say or think is it's different this time. Is the market not going to correct this time because it can stay overvalued for a longer period of time? Well, it could stay overvalued for a longer period of time, but will it always stay overvalued? And the answer has to be no. It never is. It's going to be undervalued sometimes. It's going to be overvalued sometimes. Wall Street likes huge swings in the market because that's how they make a killing. Right now, they're making a killing by just the fact that there's enough liquidity out there and enough people that are willing to keep socking money into the market that they're willing to happily sell you that stock at a big premium. In fact, hedge funds, market makers, and insiders, the CEO and board members of big companies, are in a huge way net sellers. Last I checked, it was over 90% are sells, not buys. So if there's more insiders selling, more hedge funds selling, more market makers selling, that means even the smart money does believe it's overvalued and are taking advantage of the profits that are there right now, meaning that we could have a crash imminently. Now, could it hold out? Maybe it can for a while, but that doesn't mean it's not going to come eventually. It just means we have to be careful how we invest and not to take risk on money you need for income. Again, if the market crashes 50% like it did in 2008 and as it did also in 2000, as it crashed even more than that back in 29, you've got a long road to get those levels back to normal in most cases. So what if you're living on that income? It's not going to work out for you. So be careful on that income. People do need it in retirement, and I think that's really the first place you need to look.
We're talking about markets, politics, and retirement income, what really matters right now, with Jeff Hogan of Premier Retirement Planning and Wealth Management right here in Tucson. Telephone number 520-780-9059. Jeff, there's a lot of talk of a $4 trillion retirement savings gap driving demand for pension-like income, things like annuities, Social Security optimization, and bond ladders. Why is that?
Well, the assets are there. The $4 trillion in assets are, trillions and trillions of dollars in 401ks, IRAs, and other investments. But the $4 trillion retirement gap is what it would take that $4 trillion to generate the income needed that's no longer provided by retirement pensions, things like that. So used to be companies offered pensions. You worked there 30 years and you got a pension of 75% of whatever your final salary was or something like that. And people in that case didn't really have to save because the company was saving for retirement for them. They just kept on living on a month-to-month paycheck. They continued to get it through the rest of their life, have a little bit of savings for emergencies. And in fact, even still, those people with pensions typically, might have a few $100,000 in retirement savings, typically not in the millions. Those people that don't have pensions have instead been incentivized by matching and things like that to contribute to 401ks or 403bs or some sort of a retirement or pension plan. However, those things are called defined contribution plans, meaning you can max what you put in, but you can't guarantee or even guess what the outcome is going to be other than just over the long haul, it averages X. So hopefully I have this much when I retire. Then what? Well, then you hopefully have maybe a few $1 million or $1 million or $2 million in retirement savings, but you have no pension. All you have is Social Security. And if you've been used to making somewhere between 100 or 200,000 or so as an income, you're probably not going to be able to live on $30,000 or $40,000 in Social Security. So you need to make up the difference. Well, how are you going to make up that difference? Well, hopefully you've got a couple $1 million in savings, and hopefully the market doesn't crash 50% because $2 million in savings becomes $1 million in savings if it's all in the stock market. And $1 million of savings is not going to generate as much income as $2 million. So how do you find that happy medium? Well, maybe you put half of that money into something that'll generate $40,000 or $50,000 in income. So that between the Social Security, maybe between you and your spouse, you get 60 or 70, you have another 40 or 50 in guaranteed income. Basically, you annuitize or pensionize half of your savings and get that extra, let's say $40,000 or $50,000 a year. Now you're up over 100. You can at least pay the basic bills. And now you've got $1 million that you could put at risk in the market or diversify into some stocks and bonds, maybe even a laddered bond strategy where you get at least a guaranteed rate of return and growth. over time, as long as you hold those bonds to maturity, and then maybe you can try to swing for the fences and make extra money. It's not uncommon to beat the market or just park it in an index fund and play the market. It's a roller coaster ride sometimes, and you get some good sell-offs. But if it's money you're not needing every day for cash or cash flow, it's just that I might need it in the future money, then you have a long-term horizon. You can stand to risk that. But basically, that $4 trillion savings gap is the amount of money that you need to guarantee income from. And you can't really count stocks and bonds and things that could go down 50 or 60 or 100% or 80%, like some stocks have in the past crashes, to guarantee that income. So, Americans don't have pensions anymore to create that peace of mind and confidence in retirement. So you need to recreate that paycheck. And most people need to do that using their savings. Most people who are getting close to retirement, at least the ones that I meet, most of their savings is in 401k or some sort of a qualified account that'll eventually be available to them after age 59 and a half or so. May or may not guarantee income for the rest of their life. I mean, there's certain annuities that'll do that. We like to use LERPs, which isn't guaranteed income, but it is tax-free. And we like to use portions of that income in either Roths or life insurance type products to get tax-free income. Obviously, you don't want to put yourself into a new tax bracket just because you saved well and you were responsible, and all of a sudden you retire and now all your money is taxable because it hasn't been taxed yet. And then you go into a higher and higher tax bracket. Most people believe that tax rates are probably going to go up, not go down, because of the deficits and things that the government's running and all the government abuse, waste, and fraud. Hopefully they'll get a handle on some of that, but we'll see. You can optimize your Social Security, do ladder bonds like I mentioned. Those are just some of the options available in income planning.
Talking with Jeff Hogan on Premier Retirement Planning and Wealth Management here in Tucson and Mesa. If you've saved well, but you haven't planned for taxes, inflation, and health care, your retirement may be a little more fragile than you might think. Call 520-780-9059 for your Premier Retirement Roadmap. No cost, no obligation, 520-780-9059. Jeff, let's continue our conversation here. Some listeners worry that guaranteed income products mean giving up growth. Is that always true?
Well, on the money that you put into an income type plan almost always does. I mean, you look at the long-term advantage of a stock market investment that's solid, a good blue chip stock or a good index like the S&P or the Dow, you're going to get good growth over time. Bonds are going to grow at less rate of return, but they're more geared to income because they don't have quite the volatility. Now, we've seen that to be different when we've had huge interest rate increases over a year or two, like we did in the early years of the Biden administration, where inflation got a little out of control and they had to keep raising interest rates, and it made the bond market go down. In fact, the long bonds went down 20 or 30%. So you can actually lose money in the bond market, but typically it's not as volatile. So do you give up growth by going into those less volatile or more income guaranteed products? Well, maybe. However, if I look at a stock and bond portfolio, most people come in with about a 60-40 split or somewhere in the 50-50 range between stocks and bonds. And that's just for easy numbers, use a 50-50 split. So stock market average is 10, so you average 5% on half your money's there, so you get half those returns. And let's say the bond market average is 4, so you get another 2% there. So you're averaging about 7% rate of return on average over time. But there's extreme volatility possibility in that account, and that's why you can only take 4% out. In an indexed annuity that has an income rider, I have some that if you back test them, their rates of return are somewhere between 6 and 12%, which is equal or higher than the typical stock and bond portfolio will average over a longer period of time. Now, we look at the last few years and everybody thinks, well, the stock market averages at least 20, 25%. Look at how good it's doing. Yeah, it is being a little bit manipulated and pushed way into the stratosphere as far as valuations go. But yeah, there can be some really good years, but there can also be the market falls 25% like it did in 2022, and it's going to take 35% to make up the difference. So the next year and a half is just playing makeup. And then you could start at the bottom and say, well, yeah, but the last 3 years that we start at the bottom, well, let's go back a little farther and see what the real returns are. And I think you'll find that it's typically more like in the 10% range because you have to factor in the loss years. So, if you could have an annuity that is principal guaranteed or principal protected and still average 7 or 8% and not lose money in the down years, your money will not only last longer, it will also be a situation where the insurance companies who offer those can guarantee higher income than even the 4% rule, which I mentioned before was debunked by Wade Pfau and other professionals that figured out that if we have two big market crashes like we did in 2000 and 2008 in the same decade and have that again, then maybe you should only be pulling about 2% of your money. About 1.8 was the lowest number I've seen. And I've seen one recently by Schwab that just in the last few months came out with a new income rule of thumb, which was in the low 3%. So if you can only pull 3% out of a stock and bond portfolio safely, according to the experts in the business, why not get something that's guaranteed that still has growth on average higher than 6%, maybe 8% or 10% over time, and gives you guaranteed income as well at maybe 6 or 7% of what you put in. Some people are getting 8 or 10% depending on when they put it in, how old they are, and how much they wait before they take income. But let's say you put $500,000 in there and you wait a few years, and depending on your age and the product, you might get $50,000 a year out. That's a 10% rate of return on what you put in. And if the stock market crashed during that period of time, your account is guaranteed to stay the same or grow regardless of what the market does. So you might give up some growth, meaning if you were in the Magnificent Seven stocks making 30 or 40% on average for the next 10 years, yeah, you do a lot better on that than you would on a guaranteed income. Can you really guarantee that? Well, here's my point. Let's just put part of your money in something guaranteed, call that your entire bond allocation. So if you have a 50-50 on every $1 million you own, you put 50% of it in an index annuity that gives you more net return than a 3 or 4% rate rule of thumb on the whole million, and then keep the other 50% in something more aggressive that you can wait on or use over time or use later or leave as a legacy to your heirs and get both. So you don't have to give up one for the other because you don't have to put all your assets in one or the other. You can diversify between the asset classes, between the strategies that you're using for that particular asset or account. Half your IRA could be in an income account and half of it could be in growth. Maybe half of it's moved to a Roth account so you get tax-free growth and a huge tax-free death benefit when you die because you're not planning on touching it. Or you might even, over the next few years, do a Roth conversion where you convert your IRA to a Roth over the next 4 or 5 years and take that $40,000 or $50,000 a year in income tax-free from that income account in a Roth type of an IRA, and let the other accounts grow tax deferred or even tax-free if you did some more Roth conversions. So it's not an either or decision. Retirement's kind of like building a house. You know, you've got the floor, the foundation, you got the walls, the windows, the roof, and every asset holds a different function. The foundation of the floor would be those principal protected assets that never go down. If a hurricane came and knocked down your house, it would knock down the walls and the roof, but it wouldn't knock down the floor of the foundation. It would still be there. So again, the income is always the floor of the foundation, and the walls and the roof, you can build them as strong or as weak as you want, depending on how you structure it. But obviously the stuff that's above the foundation is going to have a little bit of risk, but we can look at it that way and diversify accordingly. How much risk do you want? You want to put more money into the foundation of the base, or do you want to say, well, I've got enough foundation in the base because I don't have any bills and I don't need any income, so I can risk it all? Or a majority of it, or you know what, I just like knowing I have a paycheck that's fatter than what I need every month, and then I don't have to worry about the rest. So whatever your situation is, we can accommodate by diversifying between growth and income. You don't have to give up one for the other.
Talking with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. And once again, if you're retired or you're retiring soon and you want some confidence instead of uncertainty, call 520-780-9059 and request your Premier Retirement Roadmap. No cost, no obligation. It's 520-780-9059. You can make that call right now if you want. Leave your name and telephone number. Shelley will call you back during the week and set up that appointment for you. Once again, 520-780-9059. We would love to talk to you. Jeff, time for a break here on Premier Retirement. When we come back, we're going to be answering listener questions and more when our show continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059. or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
Thanks so much for making this a part of your weekend. You're listening to Premier Retirement with Jeff Hogan. We're on the air for you 4 times a week here. We're on Saturdays at 7 a.m., 9 a.m., and 1 p.m., and also on Sundays at 11 a.m. And we're also on the air 24/7, 365 on our podcast. Go to wherever you get your podcast, search for Premier Retirement with Jeff Hogan. You'll find this show and all of our past shows so you can stay on top of your journey towards a confident retirement. Once again, if you want to get your Premier Retirement Roadmap, no cost, no obligation, call 520-780-9059. You can make that call right now if you want. Leave your name, number. Shelley will call you back and set it up for you at no cost, no obligation, no judgment. 520-780-9059. Okay, Jeff, let's get to listener questions. Ben's listening to us in Tucson today. Ben says, I'm close to retirement and most of my savings are still in stocks. At what point does growth turn into unnecessary risk, do you think?
Well, as soon as you can't afford to take a loss, I think is probably the easiest way to decide that. we've had some incredible results in our managed portfolios. I mean, we totally beat our own expectations by double or triple what we thought we could do, and besting the market by a significant amount. But that doesn't mean we can always do that in our managed portfolios. Doesn't mean that just because you're in the market, it's always going to go up. And we know the market goes up and down. The more risk you take, maybe the more income you can get, or the more tactfully and responsibly you manage your money, the more peace of mind you might get. But again, you have to decide what your risk tolerance is, decide what you need for income. And if your income needs are met, you can risk as much as you want to. I don't think it matters if you're retired and you can still shoot for the moon with your investments because you got 3 government pensions because you were in the military and you did something else, and then you got into politics or something. I mean, you might have tons of cash flow coming in that you can't even figure out how to spend. I meet a lot of people like that, especially military people that got in early, retired early, and had 2 or 3 different jobs in different areas in the government and have multiple pensions. If that's the case, you might have no problem risking it all forever. But if you were making $200,000 a year, you don't have a pension, and your income all of a sudden goes to $50,000 because all you have is Social Security, I don't think you ought to risk $1 million all in the stock market just because, you know, the 4% rule says you can get $40,000 out and you could probably eke it out on $90,000 a year. Well, if you take more than that and the market's volatile, you're going to end up running out of money. Maybe you could take $60,000 of that, get that $50,000, be at 100, and still have 30% or 40% of that $1 million nest egg to be sitting in the market, making money and being there for the rainy day or for that extra expense or when the air conditioning goes out or when you want to take a trip. And, you know, if the market's down, you don't have to spend that money as crazily or wildly, or as, you know, you can use more discretion at that point of when to spend it. Market does well, you get some good return. You say, hey, man, I can take that 3-month trip to Australia and Asia if I want to, because, you know, the market's up and I can lock in profits and take that money out and I still have all my income needs met and I still have a growth account that's bigger than it was when I started. So decide what your goals are and decide what your income is and make sure that those needs are met first. Then you could risk as much as you feel like it. Now, on the flip side of that, I have some clients that are totally in a place where they could risk all their money, but they've worked really hard for it. And if they got $1 million or $2 million and tons of income and they just want to say, you know what, I just don't want to ever see that money go backwards. I worked hard for it. I've got a few $100,000 or a few $1 million or something in savings that I just don't want to see disappear, even though all my income needs are met. You don't have to put it in the market. You could just say, you know what, I just want something that'll beat a CD, that'll be a safe, that'll grow. Maybe it grows towards based on when the market goes up, but it doesn't lose money when the market goes down. I mean, what a concept. What a great idea that would be, is just only make money on good years and never lose money in bad years. It's available, and it has been available since probably for a good 20 years now, 25 years that these products have been available. But in the last 5 or 10, almost every company, every insurance company has some version of a principal protected account that has upside based on the market rather than just a fixed interest. And by the way, even fixed interest isn't looking too bad. You can still get a 5 or 6 year lock-in for around 5%, guaranteed, tax deferred if it's not in an IRA, and guaranteed in an IRA if you just are happy with 5% guaranteed, never to lose money and have it grow. Guaranteed for those years. Insurance companies are able to offer more money than banks are. I think maybe that's because the bank overhead, they like to live on higher margins. They got more stuff going on. Insurance companies live on a little tighter margin, so they don't take as big a piece of the profits generally. Now, they all make money, obviously, but insurance companies are charged with keeping your money safe, just like a bank on a CD would, are a little bit more efficient, can usually pay a little bit more.
Jeff, because Ben is near retirement and most of his savings are in stocks, could he possibly go to a different type of stocks? And I'm talking about dividend-paying stocks. Would they be less volatile than the regular stock market?
I would say definitely not. In fact, if you look at the last 2 years, dividend stocks have underperformed everything. I'm always looking for some good dividend-paying alternatives for our income portfolio. And honestly, government bonds, short-term government bonds have been our top performers. If you look at some of these income accounts, they might pay a 10% dividend, but they're down 11 or 12 from last year. Well, dividend stocks, when the stock market is still up. So dividend stocks sometimes just give you what would be growth in the stock. They basically pay you, and then they don't have that money to put back into the company to grow their company and grow their profits for next year. So dividend stocks are not what they used to be, where it used to be, oh, I have General Electric, they've never missed a dividend. It's always 3.5%, and the stock goes up every year. Some people say, yeah, I don't care if the stock goes down. It just makes my dividend a higher percentage. Well, it makes a dividend of a higher percentage of what the stock is now, but it's not a higher percentage of what you put in. And if the stock goes down, what's the chance of them lowering the dividend? A very high chance that they'll lower the dividend. So your actual rate of return on that dividend is going to go down if the stock price goes down for a lengthy period of time. So I don't think dividend stocks are any better than just buying momentum of stocks that are going up. You make more money quicker if the stock goes up. You can always sell and take profits anytime. And that's what we do in our tactical managed funds. Again, we do have an income fund. I haven't been thrilled with how it's performed in the last couple of years, honestly, especially compared to how the tech and gold and silver and precious metals have been moving. And they don't typically pay dividends, but they're definitely the best performance, would give you the best return on investment and the best chance of survival in retirement because they're going up, not going down. So again, I would buy dividend stocks if they get a little bit more popular and the underlying asset either stays the same or goes up, then dividend stocks make sense. But if a lot of dividend stocks are going down, I like to avoid them. And right now, I'm not thrilled with the results I'm seeing in most dividend stocks.
Ben, thanks for listening to us in Tucson. Once again, if you'd like to have a confidential conversation with Jeff, and it's just a one-on-one conversation, call 520-780-9059, and you can set that up right now, 520-780-9059. Appreciate you listening to us right here in Tucson. Next question, Jeff. Richard is in Catalina Foothills, and Richard says, how do I know if my portfolio is actually built to generate retirement income, not just growth?
Well, it's interesting. If you work with a big board brokerage firm or some of those big name people, they tell you that it's built for income because you have what they call fixed income securities, or we're diversified. So, we shouldn't get a big downturn if the market corrects. Well, that's a bunch of hogwash. We saw bonds and stocks all crash in 2022 together. If you have a portfolio of stocks and bonds, in my opinion, it is not built to generate income at all. Dividend stocks included, interest only. The only thing that would be income related would maybe be a short-term government bond that right now is paying about a 3.5% to 4% interest rate return. You can get those really cheap, and that would create some income. You could do about the same laddering CDs probably right now. But of course, interest rates going down is going to hurt CD rates. It's going to also hurt short-term interest rates. An income plan, the only income plans that, if it's built to generate retirement income, the main products that I use are annuities, because that's what they are. The word annuity is income stream. The word annuity is basically the definition of retirement income. Social Security is retirement income. It is an annuity. Whether you like the word annuity or not, you have one if you have Social Security. If you have a pension, you have an annuity. So why not transfer some of your assets to an annuity that guarantees income? Because guaranteed income is the only retirement income that I think is safe enough to bet your retirement on and to give you the peace of mind and the confidence that you can retire on your terms. If not, it's just basically a volatile growth asset or a slow growth asset that could still go down and be volatile, like the bond market. So again, annuities, I like fixed index annuities with income riders. I don't like the annuity that you just turn into income and you just get a flat income until you die, because then you end up losing the balance if you die early, if you don't live long enough to get the benefit of the immediate annuity. I like annuities that stay in your control, where you still have the balance of that account go to your heirs, or could be tapped in if you needed to just liquidate the account early because you had a limited life expectancy and didn't really care to live to your 90s, or didn't think you would, or the doctor said you definitely won't. You want to have access to those funds. And that's why I like basically a personal pension, which is created through index annuities that you purchase from commercial insurance companies that basically create a pension for you, guarantee income based on their strength and stability and the way that they invest your money in safe places. They can leverage the interest to give you more income than banks, stock markets, or bonds. And so I like those. I also like a tax-free version of it, LIRP, life insurance retirement plan, where you don't actually take your own money out. You just borrow against a continually growing account value that is also principal protected, grows when the market goes up, doesn't go down when the market goes down. But you have to pay for a little bit of insurance. That's the cost of it. Typically, over the course of your lifetime, might average about what a mutual fund would cost you, or what a management fee at our firm would cost you if I manage that money. And it would cost about the same, but you get tax-free income. And if you consider the tax-free aspect of it, the extra income that you can get out of it over and above what you could get out of any other risk type investment, it could be more than an annuity. It'd probably be less than a Roth IRA invested in the market. It gives you some flexibility as well, where you actually borrow from the account. You don't actually deplete the account by taking withdrawals. So I like LIRPs, life insurance products, and I like annuities also from life insurance companies, because they are built for income in that period. And those are the tools that we like to use for income. Just like if you got a bunch of screws to put in walls, you don't use a hammer, you use a screwdriver. It's built for a different thing. The tool is a different tool. It accomplishes a different thing. If you want to just pound nails, get a hammer and pound nails. It's quicker. Maybe the stock market sounds easier. Maybe it's a lot quicker, but maybe it's the hammer. Maybe you just need a screwdriver, a little bit more finesse to make sure you get that steady income. Again, different tools for different jobs. Still building the same retirement house, right? We're just doing it using all the tools in the bag, not just one.
Richard, thanks for listening to us in Catalina Foothills. Once again, if you'd like to talk to Jeff in person, 520-780-9059. You can make that call right now if you want. Okay, Jeff, next question is Sal, hearing us in Green Valley. Sal says, I've done well in the market, but I've never experienced a long retirement. How do I protect against outliving my money?
That's a very good point, Sal. That's the one that most people need to ask. And that's kind of the premise for the book I wrote, Retirement, The Road Ahead. It's a long road ahead. And that's the road where you don't have income coming in paying your bills. Now, you could have done well in the market. And if you were in the market for the last 30 years while you were working, I'm sure you've done well. Shoot, the market's gone up exponentially, probably 10x or more. based on what you've put in and your employers put in. Maybe 5 or 10 times what you put in is what you have in a balance right now. Now, I've learned over the years that you never get hurt taking a profit. In other words, what you've gained over those years could also go down. And we've had market corrections just in the last couple of decades of 50% or more in the stock market. Can you withstand that? Do you have other income that would help you live through that level of volatility? Or you could just believe it's different this time and that'll never happen again. Well, that's a dangerous thought because it always can happen. You have to prepare for, if you want to protect from outliving your money, I prefer to do it by using annuities and income streams that are guaranteed, even if that account runs dry. Not with all your money. You've done well in the market. Maybe you leave a third of it in the market and you put 2/3 of it into something that'll generate more income than you need, or as much income as you need to pay all your bills so that you don't have to tap the market assets. So you never have to lock in a loss. You never have to give up some of those gains. But at the same time, you lock in maybe a half or 2/3 or 3/4 of your money into things that don't go backwards ever again and give you the peace of mind and the confidence to live your retirement. I mean, here's an easily conceived idea. Let's say the stock market averages 10% a year. And let's say you put 1/3 of your money in the market and you spend down 2/3 of your money for, let's say, $50,000 or $60,000 of income. You have $1 million, you put $300,000 in the market, you spend the $1,000, it runs out, but you still get your $50,000 a year till you die. But that $300,000 that's still left in the market will double roughly every 7 years. So if you're 65, it's going to double and be $600,000 by age 72. It's going to be $1.2 million by the time you're 78. And guess what? Be $2.4 million by the time you're 85. Holy smokes. You can still get back to the millions. And maybe when you're 75, you take another $500,000, get another $50,000 in guaranteed income forever. Again, that's if you have the stock market that's averaging 10%. But again, it's because you're not taking money out every month that you know that you can actually use that as a rule of thumb and be pretty confident that you'll probably end up making that happen. Unless, of course, you have a lost decade like the 2000 to 2010. But if you look at what's happened since then, the next decade, we made up the difference. And so it's back on track to averaging that old rate of return over the long haul. So during a 20 or 30-year retirement, you can probably expect to hit those averages of 7 to 10% is probably very conservative. But that's only if you don't need that money on a day-to-day basis to live on. Again, diversify, use all the tools in the bag. You've done well in the market. Let's take those profits off the table. Lock in what you work a lifetime to achieve and lock in that peace of mind and confidence in retirement as well.
Sal, thanks for listening to us in Green Valley. And once again, if you'd like to have a conversation with Jeff, call 520-780-9059. Ready to take your call today if you want. 520-780-9059. Just leave your name, telephone number. Shelley will be back in touch. She'll set up a time when it's convenient for both you and Jeff. And we appreciate you listening to us every week here on 790 KNST. If you've got a question you'd like to ask us and you want the answer on the air, call 520-780-9059 and leave it with Shelley. Otherwise, you can go to the website, premret.com, and leave your question there. If we use it on the air, you'll get a great answer. And Jeff's book, Retirement, The Road Ahead. Okay, Jeff, let's move on to our next topic right now, rebalancing your investments as you near retirement. This is something that doesn't get nearly enough attention, I think, but it can make or break your retirement, rebalancing your investments. So, Jeff, let's start with the basics. Why does rebalancing become more important as people approach retirement?
Well, if you're a stock market guy or stock and bond guy or the Merrill Lynch or the Vanguard or the Fidelity guys, all they do is stocks and bonds, mutual funds, right? Rebalancing is basically considering the fact that bonds are supposed to be low or no risk and the stock market is a high risk. If you've been making 8 or 10% a year on your stock market investments and you have a 60% allocation to those, maybe in the last 5 or 10 years, you've doubled your money on your stocks, but in the last 5 or 10 years, you haven't made any money on your bonds because they've been up and down and pretty much sideways. So now you have 80% stocks and only 20% in bonds. And if the stock market crashes, you could lose, let's say, half of the 80, you could lose 40%. What if you went rebalance back to that 60-40? Well, now you've at least got a downside of 30%. That still sounds pretty aggressive to me. I wouldn't do that, but that's the theory and the philosophy is you rebalance by continually take those profits off and putting them off into cash or a bond or something that has lower volatility, lower risk, typically. I think that's the same thing we do. And we use our bond allocation, the safe money allocation into assets, the principal protected assets that don't go down even when bonds go down. The insurance companies that offer them, they buy a laddered bond portfolio that they take all the risk on. They give you the interest, they leverage it, they make you probably better than bond interest in most cases, or somewhere close to that. You get the same rate you would make on bonds, but the product, it never goes backwards if the bond market were to correct. So you get kind of the best of both worlds. And you can allocate as you, let's say you grow your assets from 500,000 and you've got 300,000 in the stock market, 200,000 in bonds if you give 60-40 split, then now you've got 800,000 in the stock market and, still $200,000 in bonds after 5 years. Well, what if you take that $400,000 off or even 500,000 off? You go back to that 300,000, 200,000, but you take the profits that you made in the stock market off, put it in a principal protected account, or maybe even leave 400 or 500,000 in the market and take $500,000 or $600,000 out, put in that principal protected account. And now you've actually got market exposure to the upside, no downside, locking in profits. And now you're rebalancing into safety from those gains that you made from the market. What that means really is the best way to explain rebalancing in this context is taking profits. You never get hurt taking profits. Let's take some of that profit off the table. Let's lock it in. Let's not lose it. Let's not go forward and take any chances on losing it. We can go back to our original account value, keep risking that. And every time there's a big chunk to take off the top, we rebalance by moving it into something safe. That's something that'll generate income for retirement. You can start doing that in your mid to late 50s is a good time to start doing that if you haven't already started looking towards that with LERPs and other things that you can do aside from 401k and IRA contributions. But again, as people start nearing that 5 to 15 years from retirement timeframe, it's good to rebalance and taking some of those profits off the table and putting them in a safe place. I like putting them in a safe place that still has the ability to grow or guarantee growth at a certain rate so that I can use it for income later rather than take a chance on the bond market like, say, the typical institutional investor or the stock market advisor would likely tell you to do.
Jeff, you mentioned some of those safe places and you mentioned some of the products. What are some of the other types of products that people might want to consider to replace growth stocks?
Well, there's private lending. Sometimes some people would buy notes, hard money loans, and you can do that kind of on the side. There's some private equity firms that put together real estate debt that are maybe a little higher average return than normal. That typical mortgage is 6 or 7% right now, but if you don't have good credit and need a down payment on a house, sometimes some lenders will loan it to you at 10 or 12%, but it's secured by homes. You can also do lending. There's some private equity firms that do that kind of investing, and we have access to some of them. You can also buy REITs. Publicly traded REITs are the best. I don't like the REITs that are just growing. They're almost always a ripoff, honestly. I don't like REITs in general, but there are quasi-REITs by doing private lending and buying into buckets of cash flow through these credit accounts, private equity. There's also some private equity that have more diversified approach that are available typically to accredited only investors. That's people that have at least $1 million liquid or make $250 a year as a household. It's not really a high bar to cross. It seems like more and more people are able to do that. It didn't used to be that way, but now a lot of things are available. So private equity would probably be the most alternative investment that people don't really talk about that much. You could do structured notes. That's kind of another alternative investment. I don't like structured notes when the market is high because structured notes are always tied to the market in some way. And if it crashes, you don't get your money back or your interest, or at least you lose some of it. They're usually buffered. You don't lose as much as the stock market, but you still lose, and I don't like them. I would rather have the index annuities for my hedge because they still go up when the market goes up. They don't go down at all when the market goes down. So I like fixed principal protection more than I like buffered, but those are available. You can also invest in real estate. This says you can't go and buy a rental home if you feel like being a landlord. Most people in retirement want to be a little more flexible with their time, their energy, and not be a landlord because that's like getting at least a part-time, if not a full-time job in retirement. Once you retire, you think that's going to generate some cash flow, but it might generate you more problems and headache than the cash flow is worth, especially if you're financing the house and have to cover a mortgage with the rents, and then there's other costs and stuff involved. So there's a variety of different things that you can use besides annuities, LERPs, the life insurance versions. But I think the first level is to move from the stock and bond market into the insurance products that really cover a wide range of those 5 pillars of planning that we need to look at, especially the tax piece, the income piece, even the long-term care piece and the legacy piece, because they leave assets in tax efficient or probate-free environments for your heirs. And the only thing that it really doesn't do is give you the robust growth, perhaps, that you were used to getting during the years that you were in the accumulation phase, putting money away in the 401k. So again, there's all kinds of different options. I could talk for probably hours just on all the different products, most of which aren't going to be relevant for most of our listeners. So won't go into that detail unless somebody comes in with a specific need.
Jeff, final question here. How often should retirees or near retirees think about rebalancing?
They need to have an annual review and see if it's worth doing on a yearly basis, if not more. We have our own managed accounts can be rebalanced on a daily basis. If we have earnings come out on a stock and it goes up 20%, we'll probably take some profits and reallocate it to a stock that hasn't gone up. We'll rebalance on a regular basis when it comes to just diversified portfolios. As far as diversifying from okay, I made some money in the market. Do I want to reallocate into a little bit more safe money for this next year? I like to bite off income plans a year at a time and not really worry about them during the year. We like to kind of stick to our plan for the year, unless something weird comes up, like some huge item of news that says we're definitely going into a recession or doing something different. Maybe we reallocate totally out of the stock market, sit on the sidelines like we have for a lot of the last couple of years because things were really uncertain. In retrospect, we could have a crystal ball, go back and say, gosh, we should have been in the market exactly on April of 2023 or whatever. But we do our best with what we have based on what we know today. And things are going to change between now and the next year. You don't want to be changing focus on an entire income plan when it's a 30-year income plan on a day-to-day basis. That's different than a portfolio management, right? It's more of an income plan management. And once you're retired and living on that income, let's just bite it off. And every anniversary of when we started the plan, we get together and we look and we make allocations, make adjustments. We figure out what your tax bracket's going to be. We do a Roth conversion if we want to maximize a tax bracket, or we take a little extra because you want to do a trip, and we make sure what account we take it out of to keep you in the best tax bracket possible and do plans accordingly. But even though the plans that we do are 30-year plans, they're not super rigid. They do include the fact that we're going to rebalance, or in other words, reallocate, or maybe even rethink where we take our income from year to year. So rebalancing can have a bigger connotation or a bigger, approach than just, are we selling stocks and buying bonds today? So just depends what your needs are. We'll work accordingly.
Great conversation today, Jeff. I appreciate your time today. I want to talk to our listeners for just a moment here. You've worked hard for decades to build your nest egg. Now make sure that it works as hard as you do. Call 520-780-9059 and ask for your Premier Retirement Roadmap. You'll get a plan to preserve your wealth so you can have a better retirement, create an income stream that you can count on, and also reduce your taxes. The Premier Retirement Roadmap may be just what you need. Again, no cost, no obligation for this. 520-780-9059. You can also find out more about us online at premret.com. Jeff, we're out of time for this week. I'm going to thank you for your time, but most importantly, as every week, I'd like to thank our listeners for joining us here in the greater Tucson area. So for Jeff Ogan, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.